Hello everyone. Today in this lecture we are going to talk about book building. So let's say this is a company ABC Limited and this company wants to raise the capital of 1 million. Now the question arises from where this company is going to arrange the money. So the first option for the company is to issue the IPO. IPO means initial public offering. Initial public offering means that the company is going to issue the shares for the first time in the primary market. And prior to this IPO, that means before issuing this IPO, company is not a public limited company, rather we can say it is a private limited company. And since it is a private limited company, so it must have arranged the money via its friends, its relatives, its angel investors or venture capitalists. That means before this, the company has not borrowed the money from the general public. And after the issue of IPO, the issuing company becomes the public listed company on the recognized stock exchange. So we can say that IPO is commonly known as going public. That means company is announcing that we are now public listed company and now we can borrow the money from the general public. Second option is FPO. FPO means follow on public offering. That means company has already issued the shares, company is already listed in the stock exchange, company has already borrowed the money from the general public, and this is the second time or the third time that the company is borrowing the money from the general public. So today in this lecture we will be talking about how IPO works. So the IPO works by two methods. The one of the method is fixed price method. Under fixed price method, the amount is fixed, that the company fixes the amount, that this will be the amount that the company will be asking from the general public to invest. Now when the company is asking the amount to be fixed, that means in this case the general public is not having any option to go for a bid. That means in this, whenever the company wants to raise the money from the general public, the price of the share is already fixed in advance. And demand for the shares is only known once the issue is closed. That means before the closure of the issue, even the company is not able to know how much demand is going to generate. So that means for how much shares this general public is going to subscribe the shares. So that means in such a case, there can be under subscription or you can say over subscription of shares. Now the second method by which the company can go for the IPO is book building offering. Now in this book building offering, the price is discovered during the process of IPO. That means price is not fixed in advance. Once the company has given the offer to the general public to bid, and after that only the price will be fixed. So in this case, in this lecture, we are going to talk about the book building offering. So let's see how the book building process works. So this is the process. That means first of all, the company goes for the underwriter. That means company hires the underwriter. And then the investors makes the bid for the issue. Then the price of the share is decided. And whenever the price of the share is decided, there is a transparent system in the bidding process and shares are allotted to the general public, and then the final settlement is done. So let's start with the first part, how the book building process works. So first is underwriter is hired. That means now we are going to talk how the underwriter is hired. So as we have talked that this is my company ABC Limited. So this is a company which is issuing the shares. That means this company is in the requirement of money and they will issue the shares from the general public. So what they will do, they will approach the bank which will be treated as an underwriter. Now the question arises, who is the underwriter? So basically, underwriter is the investment bank who buys the shares from the company and resells them to the general public. Now the question is how much amount the company wants to raise. If the company wants to raise a small amount of money, so the company can go for one underwriter only. But if the company wants to raise a huge amount of money, so it will be very difficult for one underwriter to raise the money from the general public. So what it does, it also approaches some other banks, maybe 2 banks, maybe 3 banks, or maybe 4 or 5 banks. And these banks are known as syndicate underwriters. And now suppose the company has taken these 5 banks. So one bank will be considered as a lead underwriter. So that will be a main bank. This will be the main bank, and these will be the syndicate underwriters. Those will be working under this bank, and this lead underwriter will be known as book running manager. Now let's understand with the help of a small example. Now suppose the director wants to make a movie. So in that case, if a director wants to make a documentary film, so that means one underwriter is important, because the documentary films are basically a short duration films, and only a one lead role actor is enough. Now suppose say in the same case the producer wants to make a big film, and in that case there will be a one actor who will be playing a lead role, and there will be various supporting actors who will be working in that movie. So the same case is for the underwriter. If it is difficult to arrange the money by simple one bank, so different underwriters are being appointed. One will be playing a lead role and other will be playing the supporting role. Now the next question is how to choose an underwriter, that is the investment banker. Now as I was talking about a movie, so whenever a director wants to appoint an actor, so the director will be giving consideration to various things. For example, what is the reputation of an actor, whether people will be coming to watch this actor in the movie or not, whether if the director hires this actor in the movie, whether the movie will be able to generate more amount of money or not. So there will be various points that will be coming under the mind of the director before choosing the lead actor or actress in his movie. So same way, whenever a company is deciding that who should be the underwriter, there are various points that should be considered. So the first thing is reputation of the bank, and the familiarity with the company and the industry. That means the reputation of a bank is a very important thing. As the reputation of bank is good, that means investors will be believing in that bank. So reputation will play a major role for arranging the money. And familiarity with the company and industry means the bank, whatever bank the company is choosing, whether that bank is familiar with the company or not, whether the bank is familiar with the industry or not. If the bank is familiar with the company as well as the industry, then only the bank will be able to arrange the money. As if the actor is there, he should be aware about the movie, he should be aware about the story. So he should be familiar about what he is going to do. So we will be looking after those actors which will fit in that movie. If the movie is a comedian movie, so the actor who does the comedy role, we are going to appoint him. So it depends on which category you want to appoint the actor. So same way we have to decide that how we are going to appoint the underwriter. So I can say that before selecting the underwriter, some points are to be kept in mind. That means we have to keep in mind that whether the investors, analysts and media will judge the caliber of your IPO based on the reputation of the underwriter, particularly the lead underwriter inside the market. So that means the reputation of your bank plays an important role, because your investor, analyst and media will judge you on the basis which underwriter you have chosen. As I told you, in the case of a movie, many people go to see the movie just because of the actor. And secondly, we can say that investment banks that specialize in working with business in specific industry can bring the experts with advanced degrees in the industry as well as other specialized knowledge to the table. And these abilities are frequently essential for comprehending the company's operations and creating a market plan, and would appeal to the target investors in the offering. So once the company has chosen the underwriter. Now the next question arises, what does this underwriter do? So these underwriters, first of all, they are going to issue the red herring prospectus. Now this red herring prospectus will be provided to every investor who buys the security. And these prospectus ensures that investors have adequate and reliable information about the securities. Now, whenever this red herring prospectus will be there, and in this red herring prospectus, there will be one effective date on which the shares will be issued to the general public, and even the offer price will be there. And whenever this red herring prospectus will be there, the underwriters will develop an initial prospectus that includes information on the issuing company with the exceptions of the effective date and the offer price. Now let's talk about various terms that will be used in your red herring prospectus. So first is your issue size. Now issue size means company will be declaring that how many number of shares will be issued. That means in the volume as well as in the value terms. Second will be your lot size. Lot size means minimum number of shares an investor needs to bid for. Then the company will be declaring the floor price. Floor price means minimum offer price below which the bid cannot be accepted. Cap price, maximum offer price above which bid cannot be accepted. And this difference between floor price and cap price is known as IPO price band, and the difference between the floor price and cap price will be maximum of 20%. That means if your floor price is 100, your cap price will be 120. So now let's understand with the help of example. Suppose the issue size is 10,000 shares and lot size is 50. Lot size means if any if any investor want to invest in your company, they will either invest for 50 shares, 100 shares, 150 shares. That means they are going to invest in the multiples of 50. Let's say floor price is $100 and cap price is 120. You can see the difference between the floor price and cap price is 20%. Now, if the minimum price that the company has offered is 100, so for 10,000 shares, it will be 1 million. And if the company has offered the maximum price that any shareholder can bid is, an investor can bid is 120. So it will be 1.2 million. So that means your value will range between 1 million to 1.2 million. Now, once these things are done, now the next step is that investors will make the bid for the issue. So there can be n number of investors that can bid for the issues. And once the investors have bid for the issue, and then the share price is decided. Now let's, for an example, in our case, we have the minimum price to be $100 and maximum is 120. Suppose if at the $120 per share, the price is 120, the value that is bid for 900,000. So that means the investors had bid for 7,500 shares. At 115 per share, let's say it's 950,000, and that means it's 8261 shares. At 110 shares, if the one share cost is 110, so 1 million, and shares will be 9091. At 105, it will be 1.1 million and 10,476 shares. And at 100 shares, if the price is $100 per share, the value will be 1.2 millions and the shares will be 12,000. Now the question arises, at what price should be fixed? Now you can see that if the company is going to fix the price at 115, the shares will be 8261 which are being subscribed, plus the person who has applied for bid for 120, they can also purchase it at 115. So in total there will be more than 10,000 shareholders. So now the company can fix the price at 115 also. But if the company is going to fix the price at 120, there will be under subscription in that case, because only 7,500 shareholders have been applied, or you can say investors have applied only for 7,500 shares. So in that case, the price will be decreased. Now, whenever there is a bidding process, transparency should be there. Transparency means the issuer has to disclose the issue size, the number of shares available for bidding to the general public. Bids are then allowed to be placed at different price points. Underwriters and issuers have to provide regular updates on the number of shares bid for as well as the price at which they were bid for. All information related to book building process is made available on all stock exchange website. And finally, the information on the cutoff price and the allocated shares to each category of investors in the end is released. So that means I can say that this transparency is a crucial aspect. Security Exchange Board has implemented several measures to ensure the transparency during the book building process. And these measures are put in place to ensure that book building is fair and transparent and the final price of the shares reflects the true demand for the company. Now, once the transparency is clear, next is the allotment and settlement. So that means I can say that once the final price is fixed, the shares will be allotted to the successful bidders. In case of oversubscription, allotment will be done on the pro rata basis. That means according to the number of shares bid for the price at which they were bid for. And if any investor is not allotted any share, their amount, whatever they have paid at the time of bid, will be refunded. And if any investor is allotted shares and he has paid more amount, then his amount will be refunded. And if the investors have paid the less amount, the difference will be demanded. So that means we are going to demand, the company is going to demand the additional amount. And the status of the company is then considered to be listed in the stock exchange. And the settlement is done 2 days after the trading date. So it can be 2 days, 3 days. So that means within 2-3 days, the settlement will be done. So now let's talk about the timeline for the IPO. So first the prospectus and the price band is issued. Then the issue will be open in the market. Issue will be closed in the market and then it will be listed in the stock exchange. So there will be a time period of minimum 5 days between the prospectus and the issue price when the issue will be open. And the issue will be open for 3 to 7 days. And if the price band is revised, for example, in our case it was 100 and 120. And if the company sees that at the 100 they are not getting the offering, that means people are not bidding at that time, they can even reduce the price. So they can go for $90 to $120, $90 to $110. So depending what band they can decrease, and if it is revised, price band is revised, it will be increased to 3 further more days. And once the share is closed, it will be listed in the stock exchange within 3 to 7 days. Now let's talk about advantages and limitations of book building. So advantages means that the price will be discovered. If the company is going for fixed price, they are not able to discover it. Investors can bid for different prices and the process will be more transparent. And the limitation will be, it will be costlier than the fixed price method. Book building process can be complex and time consuming because it can take time to decide the price. And there is a risk of underpricing of shares if the demand is not accurately reflected in the book building process. Now let's summarize it. So the first is the issuer company enters into the agreement with the stock exchange to offer the securities in online mode. And after that, appointment of lead merchant banker is done. That means company is going to choose a lead manager. And the lead merchant banker who has been appointed by the issuer company is known as book builder. And the book builder can appoint the brokers of the stock exchange registered with Security Exchange Board of the country. Now, once the lead manager is decided, it will file a draft for the offer document with the Security Exchange Board. And this document will cover all the relevant information. And this document will be known as the filing a red herring prospectus. And the red herring prospectus will have the floor price and the cutoff price will be declared. Floor price, as we have already discussed, will be the minimum offer price below which bid cannot be accepted, and cap price, maximum offer price above which bid cannot be accepted. Now, once the red herring prospectus is issued, pre-issue advertisement will be there, and which will be 1 day before the opening of the issue date. Now, the issue will be open, and minimum and maximum period for which bidding is open is 3 to 7 days, and it can be extended for 3 days if the price band is revised. Now, investors are going to submit the form, they are going to bid it, and the form will be submitted. And after the bid is done, the registration of the final prospectus will be done, and the price will be decided. Once the price will be decided, the allotment of securities will be done, and within the 7 days, the listing will be done in the stock exchange, and the issue will be closed. So this is how the book building process takes place. Hope you have understood the concept. Thank you.